Ever feel like some investors always seem a few steps ahead? The same names, Buffett, Burry, Marx, Pabrai, keep showing up with the right stocks at the right moments, while most people are still trying to understand what just happened. The difference isn't luck. Every quarter, these investors file a 13F report that shows the moves they're making with real money. It's delayed by 45 days, but it's still one of the clearest windows into where long-term conviction actually sits. So instead of guessing, you can reverse engineer their thinking. Buffett is making multi-billion-dollar bets on companies with deep moats. Burry is buying into temporary weakness with stable fundamentals underneath. Marx is loading up on overlooked cash engines, and Pabrai is positioning early in a cycle that most investors have already written off. Each move tells a story about where opportunity might be hiding right now, if you know how to read it. That is what we are going to do here. I will walk you through 6 stocks the smart money has been buying recently, explain what each business actually does, why these investors might see an edge, what catalysts could move the price over the next few years, and what real risks you need to keep in mind before you even think about touching the stock. So let us start with the most surprising move on the list, Buffett's massive buy in Alphabet today. Alphabet has become one of the clearest examples of what happens when a company already dominating its industry figures out how to make its core business even stronger while building an entirely new profit engine alongside it. That is the real reason investors paid attention when Warren Buffett bought more than 17.8 million shares, a position worth about $4,338 million at the time of the filing. Buffett buys cash stocks with widening moats, and Alphabet fits that description better today than it did even a year ago. To understand why, you only need to look at 2 pieces of Alphabet's flywheel. The first is Google services, which includes Search, YouTube, Android, Maps, Chrome, and the hardware ecosystem. Search remains a cultural utility. It pulled in more than $56 billion in revenue last quarter alone. YouTube added another $10 billion. Those numbers matter because they show consistency. Alphabet does not have to reinvent the wheel every year. Its existing products continue to generate high-margin revenue that funds everything else the company wants to build. The second piece is Google Cloud, the part of the business that has turned into Alphabet's next big growth pillar. Cloud delivered more than $15 billion last quarter, with a backlog above $155 billion. That backlog shows you something important. Big companies are not experimenting with AI anymore. They are signing multi-year deals that lock Google in as an infrastructure partner. While Alphabet is spending heavily on data centers and AI hardware, the payoff is that cloud is scaling into higher profitability while deepening customer relationships at the same time. The combination of dominant ad businesses and a rapidly expanding cloud platform gives Alphabet something Buffett has always gravitated toward: durable earnings power. Even better, Alphabet now has optionality through Waymo, its autonomous driving arm, which has expanded operations in Phoenix, San Francisco, Los Angeles, and several other markets. If Waymo reaches commercial scale, Alphabet could unlock an entirely separate cash engine that barely shows up in today's financials. Alphabet is not without risks. Regulatory pressure remains high, and AI integration into search could temporarily disrupt user behavior. But the core truth remains the same. Alphabet produces enormous cash flow today. It is investing aggressively to protect its moat, and it is building new profit streams for the future. That blend of strength and optionality is exactly why Buffett was comfortable making Alphabet one of the biggest additions to Berkshire in recent years. While Buffett leaned into long-term digital strength, Burry went the opposite direction and bought into a business most investors only notice when something goes wrong. Molina Healthcare. It is not the kind of stock that lights up financial media, but that is exactly why Michael Burry moved nearly $24 million into it. He bought $125,000, turning Molina into one of his biggest new positions. When a company is stable underneath but messy on the surface, Burry pays attention. To understand the setup, you need to know what Molina actually does. Unlike traditional insurers, Molina focuses on government-sponsored health plans, mainly Medicaid, Medicare, and marketplace plans. Medicaid is the backbone of the business, steady, recurring, and tied to essential care. The issues dragging results came mostly from the marketplace. Medical costs there spiked faster than Molina could adjust pricing, forcing management to cut earnings guidance to about $14 per share for the year. That headline alone pushed the stock down sharply. But it did not change the reality that Medicaid remains healthy and that pricing resets are already underway for several states heading into 2026. The trouble came from a much smaller segment, the ACA marketplace plans. Burry has always gravitated towards situations where the headline risk looks worse than the underlying economics. With Molina, the core question is simple. Are these cost pressures structural or cyclical? Medicaid costs tend to normalize as states adjust rates. Marketplace plans can be repriced, trimmed, or exited. And Molina has a long history of doing exactly that, shrinking underperforming books, renegotiating contracts, and tightening operations until margins recover. There is another piece Burry likely noticed: cost visibility. Molina's pharmacy benefit management arrangement with CVS Caremark runs through 2026, giving the company a clearer line of sight into drug spending at a time when medical inflation is unpredictable. That stability helps Molina control one of the trickiest parts of its cost structure. Combine that with steady Medicaid membership trends, contract renewals, and tight expense discipline, and the earnings reset starts to look more like a temporary step back than a structural problem. What makes the timing interesting is that Molina is entering a period where multiple large state contracts reset their reimbursement levels. If those adjustments catch up to medical trends, earnings can rebound faster than the market expects. Add in disciplined cost management and the possibility of reducing marketplace exposure, and the downside starts to look smaller than the potential upside. That asymmetry is what Burry looks for. He is not betting on perfection. He is betting that the worst-case scenario is already priced in while the recovery is not. Next up is Howard Marks' pick, and it is Viper Energy. Viper Energy is one of those businesses that sounds complicated at first, but once you understand how it actually works, it becomes one of the cleanest cash flow stories in the energy sector. Unlike traditional oil companies, Viper does not drill wells, buy rigs, or operate equipment. It owns mineral and royalty interests, which means operators like Diamondback Energy do all the work, while Viper collects a percentage of the revenue every time oil and gas are produced. No drilling costs, no operating risk, just royalty income that flows straight to the bottom line. That structure alone is attractive, but Howard Marks didn't buy more than 6,285,000 shares, worth about $240 million, just because it's simple. He bought it because the business has scaled into something much more powerful. The turning point was Viper's $4.1 billion all-stock merger with Sitio Royalties. Overnight, Viper became one of the largest pure-play mineral companies in the United States. More acreage means more wells turning to production, more operators working its land, and a far more predictable royalty stream. Scale is everything in this model, and the merger pushed Viper into a tier where its cash flow becomes smoother and more durable. You can see the shift in the numbers. Last quarter, Viper averaged 108,859 barrels of oil equivalent per day and generated enough cash to pay a base dividend plus a variable dividend of 58 cents per share. It also repurchased about 2.4 million shares. That is not the behavior of a company under pressure. That is a company confident that the market is undervaluing its new scale. At the same time, Viper sold its non-Permian assets for $670 million. The sale sharpened the portfolio around the highest return acreage in the country and brought in meaningful cash to strengthen the balance sheet. The risks are straightforward. Viper depends on commodity prices and operator activity. If drilling slows, royalties decline. But Marks isn't betting on short-term moves. He's betting on long-duration Permian development, limited new supply, and a royalty model that converts each incremental barrel into cash far more efficiently than a traditional oil company. And if Marks was willing to dig into overlooked stability, Pabrai went straight for a deep cycle opportunity that most investors abandoned years ago. Transocean. It is a perfect example of a stock most investors ignore right up until the cycle turns and the entire industry re-rates. Offshore drilling spent almost a decade in the penalty box after the 2014 oil crash. Rigs were stacked, new projects were canceled, and capital dried up. Most people wrote the sector off entirely. But when an industry spends that long starving itself, it eventually creates the conditions for a violent recovery. That is exactly what Mohnish Pabrai is betting on. He bought more than 24 million shares of Transocean at a little over $3 per share. a roughly $76 million bet that the offshore cycle is entering a new phase of tight supply and rising pricing power. Transocean owns some of the most advanced ultra-deepwater and harsh environment rigs in the world. Very few companies can build or operate these assets, and after years of underinvestment, almost no new rigs are entering the market. Meanwhile, demand for deepwater projects is rising again as major producers commit to long-duration developments in Brazil, the Gulf of Mexico, and West Africa. You can see that in Transocean's backlog, which stands around $6.7 billion. The clearest proof came from a 365-day contract for the Deepwater Atlas at a day rate of $635,000, levels the industry hasn't seen in more than a decade. High-spec rigs are becoming bottlenecks, and Transocean owns one of the few fleets capable of delivering what operators need. This is exactly the type of asymmetry Pabrai looks for, a deeply cyclical industry turning upward, a company with heavy operating leverage, and a margin structure that expands quickly as day rates rise. If oil prices stay reasonably stable and offshore investment continues, Transocean's earnings profile could shift meaningfully over the next several years. Of course, the risks are real. Transocean still carries significant debt, downtime can hurt revenue in a single quarter, and any pullback in oil prices can slow contract awards. But the imbalance between supply and demand is undeniable. There are not enough high-spec rigs to meet long-term drilling plans from major oil companies, and new builds take years to deliver. That bottleneck is why this cycle is different from the last one. And while Pabrai is leaning into a high-volatility cycle, Buffett's next major buy is the complete opposite: steady, disciplined, and built for long-term compounding, and that is Chubb. Chubb is not the kind of stock that gets people excited on social media, but that is exactly why Warren Buffett likes it. Insurance, when managed well, is one of the strongest compounding models in finance. It generates float, premium dollars collected today that won't be paid out for claims until later. And that float can be invested for years. But the model only works if underwriting is tight. Chubb has mastered that discipline. In the most recent quarter, it delivered a combined ratio of 81.8%, meaning it kept about 18 cents of every premium dollar after claims and expenses. That's world-class performance. It also explains why Berkshire added close to 4.3 million shares, a position worth over $1.2 billion. Chubb's strength comes from diversification. It operates across 6 major segments: commercial insurance, personal insurance, overseas general, agriculture, reinsurance, and a global life business. This mix gives the company something most insurers struggle to build: balance. When one part of the portfolio faces higher losses, another often offsets it. That is exactly what happened last quarter. While the industry dealt with higher catastrophe losses in several regions, Chubb still grew underwriting income and posted record net investment income thanks to higher interest rates. Another advantage is pricing power. Commercial insurance isn't a commodity purchase. Clients choose stability, claims handling, and expertise. Chubb's reputation in those areas drives high retention and consistent premium growth across most regions. Buffett pays attention to those signals because they reveal whether underwriting remains rational in both soft and hard markets. The biggest tailwind right now is investment income. As older bonds mature and the portfolio is reinvested at higher yields, earnings naturally rise. Insurers with large, stable floats benefit the most, and Chubb sits at the top of that list. The float compounds, underwriting remains profitable, and investment returns improve without taking on unnecessary risk. And finally, we get to the most surprising buy on this entire list, a move from Howard Marks that barely anyone was paying attention to. Howard Marks bought more than 246 million shares of Indivior, roughly a $10 million move based on the reported price, and turned Indivior into one of the most significant increases across his entire filing. Marks has spent his career investing in distressed, overlooked, and misunderstood businesses. Indivior fits that mold perfectly. The core of the company today is Sublocade, a once-monthly injectable treatment for opioid addiction. This product has become a cornerstone in the fight against addiction. Last quarter, Sublocade generated more than $219 million in revenue, growing around 15% year over year. Unlike most healthcare categories, addiction treatment does not swing with the economy. Demand stays steady, and once providers adopt Sublocade, they rarely switch. What makes the story compelling right now is Indivior's tighter strategic focus. Management cut lower return initiatives, reduced excess costs, and centered resources almost entirely on sublocade. One clear signal was discontinuing commercial support for OPVEE, an overdose reversal spray acquired through Opiant. Instead of spreading capital thin, the company chose to go all in on the product with the strongest margins, most stable demand, and clearest path to long-term profitability. At the same time, Indivior completed its move to a primary NASDAQ listing. That shift improves liquidity, increases visibility with U.S. healthcare investors, and positions Indivior to trade more in line with domestic specialty pharma peers. For Marks, this combination, simplification, cost discipline, and a growing flagship product, creates exactly the kind of mispricing he looks for. Of course, there are real risks. Indivior has faced legal challenges in the past, including settlements related to its older Suboxone film product. Litigation remains a factor, and pricing pressure from payers is always a possibility. But Marks is not betting on a perfect story. He is betting on a company that already went through the hardest part of its turnaround, trimmed the distractions, and centered its future around a product with durable demand and expanding adoption. When you zoom out, all 6 of these moves tell the same story. The smartest investors in the world are not trying to guess what the market will do next week. They are looking for businesses with real cash flow today, clear catalysts for tomorrow, and enough durability to survive whatever the cycle throws at them. Buffett is doubling down on companies with deep moats and predictable earnings. Burry is buying into temporary fear where the long-term math still works. Marks is leaning into misunderstood assets with powerful cash dynamics. And Pabrai is positioning for a cycle that most investors will only notice once it is already halfway through. Each of these stocks has its own personality, its own risks, and its own timeline, but they all have something in common. The upside makes sense because the downside is controlled. That is the part most people miss. Smart money is not chasing hype. It is accepting short-term noise in exchange for long-term clarity. Michael Burry just placed a $1.1 billion bet against AI stocks. Click the video on screen to see why.